The average first-time homebuyer in the United States is now 40 years old. Since 2019, median rents have climbed 36%, while incomes rose just 24%. And this pattern holds from London to Sydney to Toronto. The most productive cities on Earth are steadily pricing out the workers they depend on. The question is whether the rising cost of urban life is beginning to undermine the very success driving it. The steady flow of people into major cities represents a permanent structural shift rather than a temporary surge. World Bank data shows that over 80% of the global population now resides in urban areas. Across the United States, Canada, the United Kingdom, Australia, New Zealand, and Western Europe, national statistics show a consistent pattern. The largest metropolitan areas continue to capture a disproportionate share of job growth and private investment. In the 2025 and 2026 economic environment, high-wage sectors and specialized industries remain concentrated in these primary hubs. Workers move to these metropolitan centers because they serve as the main engines of career mobility. This constant influx of labor keeps demand high, consistently outstripping the local housing supply. The pressure on living costs stems directly from this structural consolidation of opportunity rather than a passing financial cycle. As long as the modern economy concentrates its highest-paying jobs in a handful of major cities, housing demand in these areas will remain structurally high. Between 2019 and 2024, a major divergence occurred across developed economies. Median rent rose by 36%, while median household income grew by just 24%. This structural imbalance transforms concentrated urban demand into a direct threat to household balance sheets. OECD housing data reveals the geographic scale of this gap. In the United States, Canada, and Portugal, the median house price to income multiple has climbed past 8 times median income, with Canada reaching 9.3 times. By contrast, European markets like Germany, Austria, and Switzerland maintain a tighter relationship between wages and housing, hovering closer to 5 times. Yet even outside the most extreme markets, employed renters on decent salaries face increasingly precarious positions. In Melbourne, 27-year-old Sophie earns a respectable gross wage of $5,200 Australian dollars a month as a junior marketing analyst. Yet her basic studio apartment costs $1,500 a month, consuming 29% of her pre-tax income. Though technically sitting just below the standard 30% affordability threshold, this high rent share leaves her financial position highly fragile. This persistent rental drain stretches the path to property ownership into middle age. When a large portion of early career income goes entirely to housing, saving for a down payment takes years longer. By late 2024, the homeownership rate for households headed by people under 35 fell to 36.3%. Even with a minor recovery to 37.9% in 2025, the fundamental barrier remains. In 2025, the median age of a first-time homebuyer reached 40, an all-time high. This delay is visible across developed economies. Since 2015, homeownership rates among adults under 35 have dropped by 3 to 5 percentage points across Canada, the United Kingdom, Australia, and New Zealand. By spending their prime wealth-building years paying rent rather than building home equity, younger adults face a widening asset gap with older generations. Behind this pricing squeeze lies a persistent deficit in physical supply. Canada's Housing Authority estimates the country needs 5.8 million new homes by 2030 to restore affordability. Yet builders completed just 240,000 units in 2023. In the United Kingdom, the annual target of 300,000 new dwellings stands against a 10-year average of just 178,000. Australia faces a similar gap. Its plan to build 1.2 million homes is projected to miss by 262,000 units by 2029, slowed by a 53% rise in construction costs over a decade. To accelerate supply, governments are reviewing planning reforms like upzoning, transit-oriented density, and streamlined permitting. Measures such as modular building and public land releases can shorten timelines, while vacancy taxes, inclusionary zoning, and land value capture aim to manage costs and retain affordability. However, these tools face hard practical limits, from local infrastructure bottlenecks to developer financing constraints, meaning actual completions lag far behind target trajectories. Even when urban wages rise, other fixed costs eat the gains. City affordability is a multi-bill problem. In the United States, official data reveals that housing consumed 33.4% of average household spending in 2024. But transportation takes another 17%, while insurance and pensions claim 12.5%, and healthcare absorbs 7.9%, leaving just 16.2% for other expenses. For families, childcare adds a heavy weight, averaging $11,582 annually for center-based care in 2023. In 31 states, low-income families spend over 30% of their income on childcare alone. Across Europe, the pattern is similar. Housing takes 30 to 35% of household budgets, while transport, childcare, and utilities add another 20 to 25%. To ease this squeeze, governments deploy targeted demand. Supports like rental assistance, first-time buyer credits, childcare subsidies, and transport relief. While these offer immediate short-term relief, they carry fiscal trade-offs and can inflate demand further, failing to resolve underlying supply shortages over the long term. These rising costs are redrawing the map of the developed world. People are not leaving major cities because they no longer want to live in them. They are leaving because the cost of staying has altered the basic arithmetic of survival. Between July 2024 and July 2025, only 1.78 million Americans relocated internally. That slowdown occurred alongside a 54% drop in net international migration. Instead of moving between megacities, residents fled high-cost hubs. Los Angeles, New York City, and Miami saw steady net outflows of residents, while secondary markets like Austin and Denver captured the largest inflows. This geographic shift is playing out internationally. In the United Kingdom, net migration fell to 171,000 from 2025 to 2026, cooling the pressure on London. Australia recorded stronger interstate movement away from expensive capitals toward Queensland, South Australia, and regional Victoria. Affordability is no longer a private budgeting issue. It is actively reshaping the geographic distribution of the global workforce, turning mid-tier markets into the new centers of growth. Essential public service workers often earn 15 to 30% less than the median urban wage. In Raleigh-Durham, a teacher earning $4,680 a month faces rent of $1,380, consuming 29% of gross pay. Across the Atlantic, a London nurse earning £3,200 a month spends over £1,000 just to split a flat, immediately hitting the 30% affordability threshold. Even mid-career professionals face identical pressures, proving this squeeze extends far beyond low-wage roles. While cities rely on these workers to function every day, the housing market consistently refuses to accommodate them nearby. Pushed into long commutes or shared housing, these individuals reveal the ultimate urban paradox: a city that builds immense wealth yet becomes too brittle to house the people who keep it running. In its April 2026 Global Financial Stability Report, the IMF warned that high household debt combined with elevated house price to income ratios raises systemic risk across urban economies. Research shows that households with debt-to-income ratios above 30% face severe vulnerability from even a 5% correction in home values. These financial pressure points are already cracking. Eviction filings in New York City and San Francisco rose 12% in 2024. Over time, housing stress erodes labor force participation and reduces the effective supply of skilled workers. When cities price out their own workforce, affordability ceases to be a private budgeting issue and becomes a structural barrier to long-term economic dynamism. When the very people who keep a city running can no longer afford to live in it, the urban engine begins to stall. The question is no longer how much growth our cities can attract, but how much exclusion they can survive. Join the discussion in the comments. Every crisis begins as a crack, small enough to ignore until it isn't.